It's been a week. We've waited long enough. It's another edition of the Real Money Show. My name is Jeremy Wiseman. I'm joined by Jerry Correia. The phone number, 1-877-8-SILVER. The website, guildhallwealth.com. That's the number. That's the website to learn how to hold physical precious metals in your portfolio. Become your own central bank because the BRICS are doing it. They're going crazy with it. And we've got the BRICS summit coming up next month, and action has been hot. Jerry, what is going on with the BRICS right now?
The BRICS are ramping up pressure. Pressure is on around the world. In fact, the demand and the weapon of choice, we talked about it last week, is silver. Silver wars are on, even gold. There are statistics happening. Data is showing that there's a quickening gold and silver withdrawal levels that are stressing the London market. We have the data. We shared this on X, and this is all in line with what's going on with the BRICS. Now, the BRICS are having a summit coming up, and that's going to be an end of October. And Chris Marcus from Arcadia Economics tweeted this or X this yesterday. As we approach this year's BRICS meeting next month in Kazan, which is in Russia, while reports of a 40% gold-backed unit payment settlement currency continue to emerge, so it's de-dollarization, Russia has just announced that they're allocating towards gold and foreign currency. They are ramping up. You heard it. The BRICS are in unison right now, pouring on pressure onto the Western systems, the countries. If they don't own the gold, they better acquire the gold. Especially by October 1st, Basel III Rules are forcing banks to get the allocated Tier 1 capital, not paper gold, not ETF gold. You need physical. They're putting pressure in unison now. China importing, India importing. We didn't talk about it last week, but Poland importing. It's all in unison. And now the BRICS, the major headline. This week, Russia is increasing its gold purchases by a whopping 732%. The West is going to have to answer by hoarding gold. All roads lead to gold. The inflation is continuing. It's not going anywhere. And Jeremy, this is a BRICS summit. It's going to be one for the ages. And again, it's just one of those things. You know, this is happening in the East, and the West is just on the outside looking in. And we talked about it last week. You know, this de-dollarization trend is only leading the U.S. to consider getting back to the gold standard.
And we'll talk about that in a little while, of what the path to a gold standard or what a path to competing with these BRIC nations will look like a little later in the show. The number 1-877-8-SILVER, the website guildhallwealth.com. Turkey attending that BRICS conference in Russia, and 54 nations are also slated to attend. So they are getting stronger. They seem to all be accumulating physical gold, and this seems to be part of the strategy. We've talked about the unit, about backing a international currency, about 40% of gold. And if they've been acquiring it, wouldn't you say, Jerry, that if they've been acquiring it over the last couple of years, there's really no reason for them to all of a sudden turn around and start offloading at these prices? I mean, if you're buying in the 2,000 to 2,500 range US, you're probably not looking to let go of it anytime soon.
That's correct. If you just look at the trends, like historically, these nations that acquire, they never export. They actually mine. You look at China. They are the leaders in gold mining. Have they once exported? Not much. Maybe never. It's not in their philosophy to ever sell your gold. There's an old proverb that says you've lived a good life if you never sold your gold. And we stand by that. You know, we believe, because what are you going to sell into, especially at a moment in time when inflation numbers are in the double-digit territory? I don't want to hear what Tiff Macklem talked about this week, talking about, Canada's aiming for the 2% inflation. Meanwhile, you're slashing interest rates. We slash back to 4.5%. The loonie is on the way down. We had a great run up last week for the loonie. Congratulations for the Canadians who actually bought gold and silver during these dips. You had a little strong loonie. Well, guess what? It's leaving. And further, regarding the exports and the selling and the dumping potentially from China and Russia, it's becoming so much more difficult to get quality out of the ground, and so much more expensive. Year over year, the mining quality and the quantity is not coming out of the ground fast enough. So why would you let go of something that is so hard to get? The rarity factor.
And also there's been a lack of investment in the mining sector. It seems to have been ignored while the price of gold's moved up $500 this year. It seems we're always we have such a short memory of where gold and silver have traversed over the course of the last 12 months and even 6 months. So, you have a lack of investment into projects, into the mining sector. I assume that that's going to come, but that'll probably come after prices of gold and silver, the commodity themselves, have moved up even further. You're just talking about Russia, Jerry, and I read something this week. Do you remember when, with the Ukraine war, that they sanctioned Russia gold and they took certain LBMA-approved gold off the
list,
the delivery list? Do you know where it's gone to?
Where?
United Arab Emirates. They've been taking all of it.
Yes, of course.
So there's always a buyer.
There's always a
for
buyer.
Gold.
Always.
And this product is legitimate product, right? It's like saying, oh, well, we don't accept diamonds from Tiffany's.
Yeah.
Right? It's like, oh, well, why not?
Okay. I'll go elsewhere.
Yeah, it's very interesting that the product has continued to find buyers. Mm-hmm. So it's another shot in the foot.
Yeah, it's
right?
a move.
They shot themselves in the foot. They didn't hurt them. They've continued to work around the dollar. So when we talk about the dollar or the de-dollarization, it is real, and it is leaving. That means if less U.S. dollars are in these banks around the world not being used, they have to come back to the U.S., which is going to cause more inflation, wouldn't it?
Yeah, absolutely. That's exactly what it's going to cause. And the de-dollarization strategy is only going to ramp up. This is the trend that we've seen. Central banks in countries such as Brazil, Russia, India, China, the BRICS are just loading up. And the strategy is de-dollarization because of the uncertainty and the volatility on the geopolitical macro fronts. This is just accelerating, and it's accelerating the need for the strategy to preserve the purchasing power of the reserves, because the reserves is what matters the most for a country. What are your reserves? A reserve it must perform when traditional and conventional arrangements in the banking system fail, currencies fail, financial systems have failed. This is why we're seeing a consolidation of the banking system. This is a very bad trend. And the time right now, the message for Canadians is to convert fiat currencies, convert your Canadian dollars that are losing purchasing power. The loonie has lost over 96% of its value since 1915. Think about that for a second. And it's not getting any stronger. You have these guys at the helm at the Bank of Canada totally lying and gaslighting to Canadians. The trend is our friend. And you know what? This is just popcorn time, Jeremy. We're just going to pop the popcorn, watch the show, because this is just going to get more and more exciting. The heat is on.
Well, you've got, if you have central banks around the world buying gold, you have to consider why you may not have gold in your portfolio. What is stopping you from doing that? What are the biases that you might have if these other countries are making very, very public moves to acquire this global asset? And the best way to see if it's a global asset, as Jim Rickards has once said, it is the de facto global currency, because when you look at how all the currencies around the world have performed against gold over the last 20, 30, 40 years, all of them are down against physical gold and silver, by the way. Both have done impeccably well to protect against inflation, which is something that we want to talk about in the next segment. along with the data heavy week.
Yeah.
It was very interesting to see what the Federal Reserve got up to this morning. We're taping the show on Friday, and the monkeying around that they like to do. We're going to show you exactly what they do so that you can follow the play-by-play the next time for yourself. In the meantime, if you've thought about holding physical gold and silver and taking advantage of this bull market, you can contact 1-877-8-SILVER and the website guildhallwealth.com. Jerry, we've got about 30 seconds.
And guys, just want to apologize for the week that was in the Guildhall Precious Metals site. It is being revamped, renewed. I'm actually revamping that with some great data, some great feeds coming in. I wasn't really happy with the old one. I really want it to become more intuitive, more news friendly, and a hub where you can sit and watch, get all the data, get all the news, and even set your alerts. So I want you guys to tune in or check out Guildhall Precious Metals this weekend. We're going to go live, set your alerts, and get notified when the prices go up by 1%, maybe buy down by 1%, and buy those dips. So bear with us. We apologize for the week that was with the Guildhall Precious Metals site. Guildhallpreciousmetals.com is still here. We're still alive, and we're just coming back with a 2.0.
You know, sometimes, Jerry, you have to take a step back in order to take 2 steps forward. And that's what we've done with the e-store. We wanted to make sure that everything was really functional, really easy for people to get on to the site, set those alerts, check out, have everything work properly. We're really excited about the new website. So if you've never purchased before and you want to just purchase, you know, your first ounce of gold or your first tube of silver maples in that crawl, walk, run strategy, you want to go to guildhallpreciousmetals.com. Jerry, let's talk about the data dependent week, the data heavy week that we saw. I want to get right into this morning's news with the Federal Reserve, and then their go-to move right after they have their announcements.
Yeah, so it was a data-heavy week. We talked a little bit about in the last segment. Canada dropped interest rates once again, and then jobs data Thursday, Friday. Yesterday, Thursday, we're recording on the Friday, so Thursday, it was the U.S. non-farm employment change. The actual figure came out at 142,000 jobs versus the expected 164,000 jobs. So that was a disaster. It shows that the job market is actually cratering, and many traders, in fact, because of that result, are now expecting a rate slash. According to the traders' report and positioning, the traders are now pricing in a nearly 50% chance that the Fed will cut interest rates, not by a quarter point I talked about, not a dribs and drabs, by a slash by maybe 50 basis points later in the month compared to about 30% just last week. So what a change with the Fed expectations.
Okay, so they're losing jobs. They're not gaining enough jobs. I think, again, I've mentioned Jim Rickards. If you look at his data and the way he looks at it, he goes, where are we at? He would say we're in a depression right now. Because if you're not ahead of where you were back in 2018, 6 years ago, if your output isn't higher than it was then, if you don't have more people employed than you had then, you're in a depression.
And that's what we get when we believe the statistics. And with the rigged data that we're getting, there's no way to know where you're at.
But before we get to rigged data, what did the Fed do after their talk?
So it was right after today. So Friday, just after a massive print in another job market data that showed that the market was further shrinking in the job figures. Just 15 minutes after that. So after that figure came out, the USD was dropping, precious metals started to ramp higher, and then the timing. Just 15 minutes after a major jobs report miss, which sent everything tumbling in the US dollar, they bring out the US FOMC member, Williams, to speak at guess where? In New York, the Council of Foreign Relations. Now, this is just
So he
crazy.
was scheduled to talk 15 minutes after this drop.
This expected number, and everyone kind of knew, I guess, behind the scenes what the figures
and
would
the
look like.
mainstream media quickly panned and cut to him talking at the Council of Foreign Relations.
And he's a great
as though they had called in earlier, like a celebrity calling TMZ to say, "Hey, I'm going to be at this restaurant.
Look over here
Tonight. at exactly 7:30. So if you catch me, oops.
And his speech was just so eloquent, saying we're doing a great job of getting inflation back to 2%. Our job is to get inflation to target, create low, stable inflation. We're doing such a great job. From the dollar that was starting to tank because of the expectations of a Fed rate cut was going on, he just saved the day. Things reversed back quickly. And this is just it. Speeches and large-scale silver paper trades are their only desperate attempt to hold back what's happening. A breakout in precious metals for the ages. They need to protect that $30 silver mark. But it's futile, Jeremy. The physical is going to dictate the price, and this is where we're headed. This economy is only fueled by hot air, currency printing, and speeches. That's what we need to know. And this is not the type of economy to safeguard your wealth and to plan for the future. How can you?
Well, here's some sauce for you. Silvercrest, one of the representatives for Silvercrest has been doing interviews lately, and they were talking about their all-in sustained costs. And what he did, I think he was talking with Craig Hemke, and what he did is he just said, okay, look, here's all the investment we've put in, here's all of our costs of production, here's inflation costs. They just did the whole bean counting on it, and they said, and here's how many ounces we have to date. What is the cost? And it was $25 an ounce. $25 an ounce. If you look at the margins with compared to where the price is right now, it is unsustainable. It's completely unsustainable. And then when we look at where the metal's coming from and the usages for the metal, right? The demand on the metal, you could say, I was listening to an interview with Peter Krauth.
Yeah.
And he's been talking about this a lot lately. He's been doing a lot of research on this, of where are they getting this excess product from if there's a deficit. So, you know that China's been producing so much solar power that there's probably like a glut of solar panels there, and they've used a certain amount of silver. But now there's new solar panels coming out that are way better.
Yeah.
And of course they take 100%, 120% more silver to produce those. So if all of the ones that are sitting there in China just rusting, you have the new ones that they're going to need going forward that are going to be demanding even more. So even if you recycled all of the silver out of those silver panels sitting there doing nothing, you're still going to need it for the new ones. Now, we've talked about Samsung's solid-state battery. This is where you can charge your car in 9 minutes and run 900 kilometers.
You need silver.
But you need 2 pounds of silver for this technology.
Kilos, yeah.
And when you start to think about if, I haven't really dug into it, but peripherally, I'm seeing the rhetoric that Trump is using on the campaign trail. He's really upping the ante. He's saying things like, we're going to lower regulations to get drilling as fast as possible and get inflation down. And we do know that one of the reasons why inflation came down in 1980 was because they just opened up the Gulf and all the refining capacity. So getting cheaper energy, which would compete with the green energy deal, I'm just putting it out there. If you can get inflation down just by getting energy prices down and all of these sorts of things, that's good.
Yeah.
That's fantastic. But you still have the debt to deal with.
Of course.
Right? So it's one thing to say we can get inflation down. We can sort of take the money that's coming in and reassign it to different places and cancel money being spent in all these places, assuming he wins. That they're better with the budget, just like what Pierre was promising, being better with budgets. And then we can take the funds, redirect them, and get inflation down. Not by fiddling numbers, but by actually doing things that can help that situation. But that doesn't get rid of the debt.
No. You can't fudge numbers.
I would like to see inflation come down as much as anybody. The problem we're having right now, Jerry, is that lowering the interest rates does make it cheaper to borrow, which is more inflationary. And you're not getting rid of the debts. And having to pay off the debts, how are you going to do it? You're going to choke off the economy or print more money, which is inflationary. So the Fed is in a debt trap, in an inflation trap. And so, yes, there may be an outside Hail Mary way of getting inflation down. And it will probably come down as a natural course of history. But you're still going to have to deal with those debts. So then what?
You can't fudge those numbers. Debts have to be dealt with a policy. A policy is going to deal with the debts. And this is the reason why things have been tabled and policies have been put into place and structures have been put into place. But it's the thrust of the BRICS that's driving a return back to a revisit of the gold standard. Now, this was insane that this was a post that the Kobesi letter talking about debt. Interest expense on U.S. federal debt is now at a record $3 billion per day. This is triple the amount paid 10 years ago and has doubled in just 2.5 years. Total annual interest costs now on federal debt reached a whopping $1.1 trillion in the second quarter. I think, just remember last year we were talking about it's almost going to break 1 trillion. Well, guess what? We're at 1.1 now, 1.1 trillion to service the debt on the interest costs. Even if the Fed cuts rates by 1% and all government bond yields decline by 1%, daily interest expense will still be at $2.5 billion. That would be more than double the average paid in 2009 to 2019. The debt crisis is an understatement, Kobesi letter. I couldn't agree more. That's absolutely what's going on.
You could absolutely slash inflation. You could slash budget, slash spending, and you still have a $34 trillion deficit that has to be managed.
Dealt with, yep.
Yeah.
So focus in back on the solution. We saw the solution when prices are rising. It was a very quick fix that happened in Zimbabwe. They backed the currency with gold, and immediately within a few weeks we saw deflation. Now you think deflation, that's a very bad thing. My house prices are going down and this is going down. Well, it's called affordability. Your money is now purchasing things at fair market value. The argument would be that the U.S. is on the outside looking in, that they have to get involved, and the U.S. could counter BRIC de-dollarization with a gold-backed strategy. This could push gold to $27,000 per ounce. This gold revaluation topic to address the U.S. debt has been proposed by several financial experts whom we've quoted many, many times. Among them, Jim Rickards, number one. He suggests that revaluing gold to $27,000 per ounce could back the M2 money supply, providing stability to the dollar. Now, these are experts, Jeremy. Luke Groman proposed revaluing Treasury gold reserves to $20,000 per ounce, potentially reducing the debt to GDP ratio significantly. That is a problem. What's the debt to GDP ratio at the moment? It's over 100%.
Yeah.
Judy Shelton, she advocates for a return to a gold-backed monetary system to restore fiscal discipline. Don't we need that today, especially in Canada? This concept involves marking up the value of the U.S. gold reserves, using this increased value to buy back Treasury debt and potentially issuing gold-backed treasuries. Proponents argue this can help manage the national debt and stabilize the currency without causing immediate inflation.
Let's stay on this topic. This is very important. Is this John Forrest Little, by the way?
Yeah, Silver Academy.
Amazing.
Great work.
The number 18778 Silver, the website, guildhallwealth.com. Imagine if gold revalued to 27,000 and you had 50 ounces, 100 ounces, 200 ounces of gold in your portfolio, or even 10 ounces of gold in the portfolio. Imagine what that could do for you if the market did that. Now, if gold went to $27,000 an ounce and we hit a 16-to-1 ratio gold to silver, you're going to be looking at over $1,600 an ounce
US, not Canadian loonies.
for silver, which would be absolutely crazy. Can we get there? We'll look into it a little bit more in the next segment. If you want to get involved for the first time, pick up your first ounce of gold, your first 10-ounce bar of silver, you can go to guildhallpreciousmetals.com. If you want to learn about holding actual physical gold and silver in your registered account, your RSP, your TFSA, your RIF, your LIF, and have it allocated to you, held in a vault outside the banking system, safe as can be, stored at BRICS, fully insured, fully secure, buy and sell on a phone call. You start with a phone call to us, 1-877-8-SILVER, the website, guildhallwealth.com. It's amazingly simple. We'll walk you through it. Check out our reviews on Trustpilot. You can see how other people are enjoying having physical gold in registered accounts. Jerry, I love that comment you made earlier about, you've had a successful life if you've never had to sell any of the physical gold. Now, right now, I think people are putting into accounts more than the sort of allotted 20% or recommended 20%. That is a great hedge against inflation, against stock market devaluations, against currency devaluations, against geopolitical risk. All of these things are mean having wealth insurance, and physical gold and silver have been great wealth insurance over the last 20 years, absolutely. And the big reason is because there's no counterparty risk. They're limited. I love how crypto people say, well, it's not completely finite like we are. It's 1.5% a year added to the stockpile. I mean, where are we on the spectrum here? We're pretty much right next to each other. It is very rare, and it's dependent on so much logistics and money investments and all of these things to get it out of the ground. And that scenario itself is not looking good right now, especially on silver, when the majority of it is mined as a byproduct of copper and zinc and gold, and the usages continue to expand. So I'm excited about where things can go from here. Admittedly, I'm being lulled to sleep a little bit on silver. It's a little bit of, when's this going to happen? But you keep seeing the drawdown of inventories. You keep seeing these slams that seem to last for a day or two, and it keeps bouncing back very quickly off of these. We keep getting closer and closer to this $29, $30 mark, which seems so important to them, that once we pass over this line, whoever they are, by the way. We know
who they are.
The strong dollar policy, they who make money off trading this back and forth and do not want to see the prices go higher, because it innately tells people that there's a problem.
It's a problem with the currency.
There's a problem that you can't paper over and pull out a guy from the FOMC to say everything's okay. Because if the price of gold and silver are skyrocketing, you know that something's wrong.
Yeah.
So they want a controlled retreat. And this year, gold's up over 20%, 25%. Silver's up over 20, close to 25%. It's not a very good retreat, but it has been controlled. Once this thing breaks 25, it's going to go crazy. I mean, not 25. I mean, once it breaks 30, it's going to go crazy again. We've been up as high as 32. We didn't quite sustain it. But what happens when we get to 50 and Joe Public decides they want to get involved? Where's the metal coming from? What happens when things are doing well again and people want all of the new technologies that demand silver in it, like these new batteries, these new solar, and things we haven't conceived of yet? Imagine how much usage they can be. And I'm sure they'll get better and they'll use less and less over the time, but they'll need more and more of it because we'll all want those widgets and those gadgets that it's required for. So from an industry standpoint, it's pretty exciting. Just have some patience. It's performed well. It'll keep performing well. But let's talk about revaluing, as you just talked about in the last segment, to $27,000 an ounce on gold.
Well, this is where we're leading towards a gold revaluation, and this is where the solution comes from to deal with the debt. Now, we were lulled, and we are continuously lulled to sleep. The tampering of the markets through through speeches and through the comics deliveries. The LBMA this week had 1,130 deliveries. The deliveries that are happening out of the exchanges, it is a bleed that's going on, and the psychology when they need to get it. When you cannot get the silver over $40, $50, the psychology will drive people towards it, drive entities and institutions toward it. So this is going to be that coiled spring effect that drives the silver into and over the hundreds very, very quickly.
And also being pulled up by higher prices of gold, right? When that ratio is widening to 95%, gold's not coming down.
Yeah.
You have to start having a catch up because people are going to say, oh, look at the economic decision. I can buy this much cheaper.
And this is not just coming from demand. The demand is not just coming from institutions or industry any longer. We have full on countries, China, India, Poland. Now Russia is going to be this month, September through October. Their mission is to increase its gold purchases 7 times, 732%. They're going to be going into the gold market and putting further pressure on the London market. And this is the report that came, and I posted this on X earlier, the Jensen's Economic Precious Metals and Markets newsletter. You want to check that out on our X, because what it shows is that the pressure that's happening at the exchanges, there's an elevated implied silver lease rate. If you're lulled to sleep on silver, what this is showing is that there is a very similar story to gold, that the cost of keeping these contracts, these paper contracts going, you don't have any money. You need that physical. The silver market is not adequately supplied, he writes, supplied to meet the withdrawal levels at these current prices. The gold and silver markets are demanding higher gold and silver prices to meet current physical demand. Physical withdrawal levels right now, along with the elevated physical market stress, indicate that the gold and silver markets are going to become even more interesting, especially because the U.S. has to deal with this effect. The West has to deal with the effects of what's going on, and it'll have to deal with the debts. The revaluation is here. We have to address it. It's a fun topic, and if you've been lulled to sleep like we were this week, silver's up like 2% this week on the back of, but there's data coming up. The data would be September the 18th. We have inflation numbers coming out next week. But the big date is FOMC. September 18th, the Federal Reserve is scheduled to cut interest rates.
It's amazing to think about individually what gold and silver have done. 'Cause gold's up over 500%. Imagine what that's done for your portfolio over the last 20 years. Last 5 years, I think it's up 65%, close to 70%. Imagine what it's done over the last several years for you. You start to think about a central bank that has 20,000 tons, what that's going to do if it gets revalued or just continues its march higher, what that does for a nation. Especially nations that don't have the same debt issues that we have here in the West.
Shackles get unlocked, debt shackles get unlocked, independence from the corruption that we're seeing, independence from, these rigged and these desperate statisticians, the Bank of Labor Statistics, this bureau of just fake numbers, constantly revising. You're freeing yourself from that when this revaluation happens. It's total freedom, and I love it. I love the topic, and I could talk about it all day.
The number 18778-SILVER, the website guildhallwealth.com. Give us a call. We'll show you how to hold physical gold and silver in your registered account. It's very easy, and you can also acquire it directly at guildhallpreciousmetals.com. We've been talking about a sound money, trusted assets, perfectly secure and stable, time-tested. This is why central banks have been buying it. We love harping on the fact that central banks are buying it because they know better than everybody else. And it's ironic that the Federal Reserve, who does own gold, will absolutely 100% not talk about it.
Nope.
Now, we've have some gold experts who are talking about fixing the debt issues because spending $1 trillion to service the debt is completely untenable. You've got to deal with it. You're going to have to deal with it some way. Many different ways to get it down. Productivity would be one way. Another way would be to devalue the currency, right? The debts will get paid, but we just can't guarantee the purchasing power of the dollar when you get it. Now that implies that individuals have to watch out for themselves in understanding that the currency is devaluing. But these major experts are calling for $27,000 gold, 20,000 plus. How do we get there? Mm-hmm. Is it just a straight overnight? They say we just need to revalue, or is it a sort of bull market that just runs the price higher? And what kind of roadblocks could we see along the way?
Mm-hmm. I think it could be a combination of both, whether it be a catalyst that will drive the price and even like a gold revaluation account that you have on the balance sheets at certain banks like Holland. The Bank of Holland has an account that will digitally revalue the gold price. That is one way to do it. Or the catalyst could be on September the 18th. If they do cut interest rates and slash it, that can trigger the prices to skyrocket. That will cause the inverse correlation to occur when you see the dropping of the US dollar and a skyrocketing of the price, triggering the psychology of everyone to now buy and take delivery. It's going to be a domino effect, Jeremy. It's going to be a very exciting one, especially if you already own, if you're already like that central bank that has a position of thousands of ounces. And all we want to do, all I want to encourage people is get those ounces. Get yourself 2,000 ounces of silver, which is around just under $90,000 Canadian, to get yourself financially ready. Because at the end of the first gold cycle, which Jim Rickers talks about, silver ended up, all you needed was about 2,000 ounces of silver to buy a home. And this is a goal for many people, is to either pay off your debts or own something without involvement of a bank and mortgages and more debt, right? So we're going to see it. How we get there, it will be a combination of demand and, central banks just revaluing.
Do you think that moving to something like $7,500 gold would be enough to really make a dent in the debts and make a big difference to the economy overall?
Yeah, it's a question of, I guess, debt to GDP, or if you are in finance or in mortgages, your TDS and GDS ratios, how much money do you make? What are your expenses? How much is the home? Is it $1.5 million? How much is your down payment? Remember, the down payment is your reserve. It's the collateral. It's the guarantee. That's what we're talking about here. The asset, the tier 1 capital, is the reserve that must be revalued upwards in order to bring that debt down. If I came to the bank and I said, well, I need a house, I'm putting 800,000 down, well, I'll just have 500 or 600,000 debt. I'll have 40% debt. Well, that's how we deal with these ratios. And with a higher gold price, we're now just figuring out where do we want to be. Right now, the debt to GDP ratio is close to like 150%, right? So where do we need to bring this down to? 20?
Well, and I think as well as far as a savings is concerned, putting your money in the bank, putting it into locking it in for a year, 6 months, you're getting 4%. If you're lucky, I guess it's maybe even less now. It's nothing. It's not going to get you ahead anywhere. And holding physical gold and silver, it might seem like a risk, but if you look at the long-term charts and you understand that it's an actual asset that you're holding, and if you can look at your savings over anything over myopic view of over a year, looking at a timeline of 5 years, if you're 25 and you're saying, I'd like to own a home in 5 years, good luck getting an interest of 4% and it's dropping and getting anywhere over the next 5 years. But you could certainly put the money into gold and silver, and yes, there's a cost to get involved. But once you're ahead on that, there's no looking back.
Right.
And, you really have to think about, well, you got to sell it. There's cost to there's like an opportunity cost, logistics of, I got to take it somewhere, I got to sell it. There's all these things that can stop you from doing it in a way, in a good way. Mm-hmm. Because it's making you think, do I really need to sell it? Whereas if it's just cash in a bank, numbers on a screen, it's very easy to just take it out and say, well, I'll just spend it.
Very true.
So I feel like gold and silver as savings over the years, speaking from personal experience, has been such a good way to save money and build wealth over time. Mm-hmm. And it's not to say it's the only way to do it, but certainly for a portion of the portfolio, It's been fantastic.
Yeah.
And we're in a bull market, so why not look at it now?
Yeah, absolutely. This bull market is here. We are on the tail end. Going back to Jim Rickards, who talked
We're in
about
the tail end?
the tail end of the third bull cycle in precious metals.
Is there 4?
We'll see. We'll see, right? So, remember the first 2 cycles from 1970 to 1980, and then 2000, 2010. The third cycle, which started in 2016, both previous cycles were 10 years. So if we started at 2016, 10 years, that's 2026. So this is where you want to be positioned. You want to be looking at precious metals because where we're going to end up, I think we've broken the all-time high about 20 times so far in the gold market. We're going to keep going. And the catalysts are all there. The demand is all there. And, I talk about stats a lot and the statistics, and I say that these numbers are rigged. And we usually use, stats coming from, Shadow Stats, for example, John Williams Shadow Stats. Great resource. I highly recommend it. But I just posted again on X after listening to Tiff Macklin, our Bank of Canada governor, speak this week. How they've been rigging the inflation numbers. This is national news, so you don't have to worry about Shadow Stats, this fringe, underground market. You can check it out yourself. Go to the National Bureau of Economic Research with Larry Summers of Harvard. He wrote an amazing article called "The Cost of Money is part of the cost of living." They have rejigged and excluded the cost of living in the CPI basket. So if you really wanted to bring inflation down, all you need to do is start to rejig your basket some more, start to exclude some items from the basket. So I encourage you to check out that report. I have it on my desktop. I can share with you if you really want to combat the whole inflation narrative. It's all a sham.
We'll be tracking all of this inflation, the debts, how gold is going to help to fix that, how gold is going to help you survive and thrive in the new economies. And we just want to thank everyone for listening to The Real Money Show. If you've never gotten involved, you can contact us directly at 1-877-8-SILVER and the website guildhallwealth.com. If you've missed a show, check us out on YouTube, on Rumble, on Spotify. Check out all the news throughout the week on our X. And we can't wait to speak to you next week here on The Real Money Show on 640 Toronto.